Hi everyone, and a very warm welcome to the FY18 Q4 and full year results call. As we have typically done in previous calls, before we open up the lines for your questions, I just wanted to provide a perspective of our results that we announced late last evening. As you may have seen in the published results, the underlying net sales grew by 9% in the fourth quarter, helped by strong growth in the prestige and above segment, where the underlying growth was 14%. This quarter was a prime illustration of the underlying strength of our business, as several regulatory challenges that we faced during the year are now behind us. And as you would remember from the last call that we did, I actually expressed that we were disappointed with the top-line growth because of the regulatory changes, but we were going to continue to invest behind the business because we believed that growth was around the corner. And I'm particularly pleased that we have delivered this kind of growth this quarter. For the full financial year, the underlying net sales growth was subdued at 1%. This sales growth should be seen in the light of the external operating environment for the industry during the year. And indeed, this past fiscal, I think, was the mother of all years as far as our industry is concerned. We had huge external headwinds with the highway ban in the first quarter, the implementation of GST in the second quarter, and uncertainty caused by expected route-to-market changes in certain states in the third quarter. In addition to that, we also navigated route-to-market changes in 3 states during the course of the year. And I dare say that this previous quarter, Q4, was really the only relatively stable quarter where there were no big regulatory changes that hit us. But it does go to show what is possible when we have a relatively benign regulatory environment. Our premiumization strategy is yielding results, with the prestige and above segment growing much faster and now accounting for 2/3 of our net sales, with an underlying net sales growth of 4% for the full year. Our fit-for-purpose model for the popular segment is also progressing to plan, and we have now completed franchise agreements in the majority of the states where we had planned to do so. And what I can say is that, as with the implementation of any new model, we did have hiccups in some states during the transition, but by and large, all that is now behind us. As a result of that, net sales of the popular segment in priority states grew by 2%, even as underlying net sales of popular segment declined by 4% during the course of the year. During the year, we have delivered underlying gross margin improvement of 294 bps as positive mix, extensive price increases, and our continuing focus on productivity savings more than offset any adverse impact of GST. The gross profit improvement has allowed us to significantly increase investment behind our brand, and our marketing investment was up 18% during the course of the year. So if you look at that in the context of a relatively subdued full-year top line, we have put our best foot forward and said we're going to invest in the growth of this business and the growth of the category. Underlying EBITDA margin of 13% remained broadly flat, as the increased gross profit was partially invested back into the business. I am also pleased to report a 29% reduction in our interest costs, and that resulted in interest cost savings of 108 crores for the year. Other income for the year was 206 crores, up 85% over the last year, as we managed to sell some of our non-core assets. Our improved operating performance, continued focus on reducing interest costs, and monetizing non-core assets together with lower exceptional items have resulted in a PAT of 562 crores for the year, an increase of 231% over the previous year. As a result, our EPS has increased to 38.7 rupees per share. On the balance sheet side, we have continued to deleverage and reduce our total debt by 20% during this year, partially as a result of better working capital management. I would also like to highlight that during the year, USL achieved upgrade of its long-term credit rating to AA+ by CRISIL and Micra and made an issue of NCDs of 750 crores. This will help to further lower interest costs in the coming future. Another point worth noting is our recent decision to split the shares in the ratio of 1:5, which has been approved by the board and is now waiting shareholders' approval. This move will increase liquidity in the stock and improve retailer investor participation due to the lower share price post the split. This stock split has historically been shown to marginally increase shareholder wealth. Overall, despite such a challenging environment, we have continued to execute against our strategic priorities. And what I am particularly pleased about is the progress we have made in ensuring that pretty much all lines of our P&L and with the fourth quarter, even our top line, all lines of our P&L are moving in the right direction. This reinforces our confidence that the work we're doing will enable us to capture the long-term opportunity in the spirits market in India, on which we have absolutely no doubt. I would like to reassert our medium-term ambition to grow our top line by double digits and improve the EBITDA margin to mid to high teens. With that, I'm going to open up the call for questions, and my colleague here, Sanjeev Churiwala, will join me in responding to the queries that you have. Over to you, operator.
Sure, thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, thanks and congrats on good numbers. My first question is, in second half, the ad spends have increased significantly. The question here is, would your share of voice, would it have increased significantly? And what's the split between ATL and BTL? And in 1 or 2 states, the advertising is proposed to be banned in terms of the point of sale. What is going to be the impact from there?
So yes, we have consciously increased our A&P spends in the second half of the year. And I would say that we have now reached the levels of spends that we believe are appropriate. We may prune it back a bit in the future depending on what's optimal. We're unlikely to increase it further as a percentage of NSP. And I just want to make sure that everyone understands that this is not something that's going to continue to explode at this level. This A&P number that you see here does not include BTL. It is A&P, which is really above the line advertising of our brand, and spends that we put for brand building in store. Okay. Now, we believe in following the law of the land. If displays and spends at the market level is not allowed, then we do it where it is allowed. So typically where it is allowed is inside the store or certainly in the bars. And there are different ways of engaging consumers without necessarily doing overt advertising at the ground level. So one thing about this category is that one has to be very dynamic and nimble-footed about how you spend your marketing money. Digital is a great opportunity. Doing in-store and in-bar communication with consumers and engaging with consumers who walk in is a great opportunity. So there's no one-size-fits-all model, Abneesh, that we can do everywhere in the country as the same. It's actually tailored and crafted on a state-to-state basis. But suffice to say that we are feeling good. We don't have the exact numbers handy, but I believe our share of voice would definitely have gone up with these spends, because I don't think our competitors have increased spends the same way. And we are beginning to see the fruits of the investments we've made. You all know that advertising investment doesn't deliver in the same week or the same month or even the same quarter, but they contribute towards long-term equity building, and that will hopefully pay out with dividend in the coming quarters.
Sir, one or two follow-ups here. In the previous quarter con call, you had said 10% will be the advertising to sales ratio, while for the full year it's lower. We should take this 10% number going ahead, right?
I mean, the full year number is 9.6%, right, Anish? I mean, what's a few decimal points between friends really, huh? I mean, who knows, right? It's not that precise a science. I'm just telling you, roughly, ballpark, we are now in the zone of where we would like to spend. I'm unlikely to increase it significantly beyond this. I'm unlikely to reduce it significantly. Now it might hover 50 bits, 100 bits here and there on a quarter basis as we, just see what's optimum. And that's something that's dynamic, and we're going to manage that accordingly.
So my second and last question is on the route to market. In the previous con calls, you had said no change in retail sales and market share will be there. And in H2, you had taken the conscious call. So now from April 1, are you seeing now business back to normal? Any of the states, is there some issue? And will you be gaining eventually from a market share perspective longer term because of this route to market change?
So I would say that both from a route to market perspective, for the moment, we are in a stable zone and there are no major issues and it's business as usual. Having said that, in this industry, what I've learned is that this can change overnight, okay? And you never know what is the next funny that's going to come. I think another piece of very important good news is that largely speaking, April is the month of the excise cycle for most of the states in the country. And I would say the excise policies have been relatively stable. So we've not seen significant increase in excise duty translating to significant increases in consumer prices. And that has continued to contribute to a stable environment. Some states have actually evolved, I would say, for the better. Punjab and Haryana never changed. I think UP is a positive, generally speaking, in terms of what's happened. So all in all, I'm feeling actually quite good about the fact that we're having a stable environment ahead of us. Absolutely, this should gain to market share gains as we look into the future. And we are absolutely working on making sure that we can achieve that and deliver that.
So one follow-up in UP, what is the positive? Could you add some color there?
No, I think it's just become more of an open market situation in UP. Right? I mean, no major change in prices and so on, though there have been some reduction of consumer prices, post the new excise policy getting implemented. But there are many more people now involved in wholesaling in UP, and therefore it's more of an open market and a free market situation. And we've got to believe that's generally good for consumer goods companies.
Okay. Okay, sir. That's all from my side. Thank you.
Thank you, Abneesh.
Thank you. Next question is from Avi Mehta from India Infoline. Please go ahead.
Hi, sir. Sir, essentially, it's been almost more than a year now that we have, we've done franchisees, we've had a relationship with partners. Could you share your thought on, what is the next step from here on? Because you had indicated that you want to increase this share and move it into more states. Any, timelines that you have in mind? By when do you kind of seek to achieve that? And, or, are you satisfied with the current state over there? And second, on the margin side, if you could give any sense on how the molasses and the ENA prices are moving, and any color on that. Those are the two questions from my side. Thank you.
Yeah, sure. I'll answer the first part. I'll hand over to Sanjeev to answer the question on margins and commodity prices. On franchise, we have pretty much reached where we wanted to reach. Okay? There are still a couple of small states, but I would say a large part of our key volumes have been converted to franchise operations where we wanted to. And I would say that with some hiccups in the past, we are today in a reasonably stable operating environment with our franchisees. And we are supporting our franchisees where needed to help them grow the business and help them to grow share. So this is a strategy to remain competitive in those states with the popular business, and we are going to provide them whatever support in terms of brands and quality and so on that we need to. So I would say you should read this as we're very close to the end game of the franchise, and therefore, this thing about the difference between underlying and reported and so on, I think these differences will start easing as we look into the future. Sanjeev, over to you for the margin question and molasses DNA.
Before Sanjeev, is it possible to just one clarification on that? Anand, just in that one, so would you see that the regular performance, essentially, that or popular segment performance that we are seeing, that should start moving to the positive territory, say, in the first half, or how? That's what I wanted to kind of understand, if there's no more franchising then. Would that be a fair?
Yeah, so there'll be no more franchise, and, I'm not going to really give you an outlook on specifically how popular is going to fare. All I'm going to say is that whatever we are largely now, which is with us, which is retained, we are focused on, it is strategic, we are going to invest both above the line and below the line, and the idea is to grow that business, right, and also grow share in the business in retained states. That's our intent, and as you can see, even in the past, we've generally grown our business in our retained states, right? It's because of the business model changes that the optics of our popular numbers don't necessarily look so good. So I think you should believe that we are going to invest for the future. The purpose of retaining is to grow it. The purpose of retaining is not to decline it. To grow it, and that's what we are going to do. So you should believe that it's going to be positive, certainly in the key priority state.
Perfect.
Okay, Sanjeev, over to you.
Yeah.
Thank you.
Thank you. Just talk about the inflation on the commodity. Just to add to what Anand said, because this is the question we normally get offhand, is saying how many states have we franchised, what kind of NSV, and what kind of million cases we have done that. Just for record, now that we have franchised about 13 states, it's roughly on an annualized basis, we're looking at about 9.6 million cases that we have franchised, and roughly about 650 crore of NSV that has been franchised. And my request would be you can write down to need it separately to get a complete breakup so that, next year modeling should take off with one-off thing. Otherwise, most of the times I've seen analysts report not really considering this franchise movement. And as a result, your forecast on the top line and the margin enhancement really doesn't look at the underlying properly. So that's a request. Now coming to the input cost inflation, that's the question that you're asking. I think the commodity price environment has been benign in the past year, and we have really managed to mitigate inflation completely. And that has been a state of affairs for the last 2 years, while generally the business would have faced an inflation of 2 to 4% depending on the commodity we're looking at it. But I think we have really worked hard across mitigation through productivity initiatives. And for the last 2 years, if you see, especially the financial year 17 and now financial year 18 end, we have been able to manage 100% inflation. And as such, our cost per case is almost flattish. And that's something which is also adding to the underlying GP margin enhancement that you see. Very specifically on the molasses, yes, we have seen some benefit coming out from the reduced molasses prices in the last quarter. But that benefit to us is very limited, given that MENA forms only about 25% of our overall ENA requirement, right? And we do believe that we should see some benefit coming out in the next quarters. But however, most of these commodity prices, behave erratically. It's very, very difficult for us to really say in the next 3, 4, 5 quarters, will it radically change here or there. But we have been lucky so far. The last 8 or 9 quarters, we have kind of managed with a very, very, very low inflation base. So I think that is kind of reflected in the base as well now.
And I might just add that, while there is no direct correlation, with crude hardening, right, and we all know what's happening with petrol and diesel prices in India, but with crude hardening globally, right, what the outlook is going to be on grain ENA and molasses ENA, and what that interplay is going to be because of ethanol blending and so on, is a complex piece and it's hard to predict.
Okay. And sorry, just one clarification. The net sales from franchising was 644 crores, right? What is the number?
Yeah, that's what I said. Roughly about 650 odd crore on an annualized basis. So, of course, the franchising happened over various quarters, right? So, to really look at the numbers, then you have to see how does the annual number look like and what is the exact implication for that in this particular year. So to break it down, absolutely for the year, net of all the royalties and all is about 400, roughly about, let's say about 500 crore.
Okay, perfect, Sanjeev. Thanks a lot. I'll come back in the queue for any other questions. Thank you.
Thank you, Abhi.
Thank you. Next question is from Arnav Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Congrats on a good performance on the top line and gross margins. Just on the volume growth, you've seen this significant recovery. Just wanted to understand, is there any component of restocking in the channel in the states where there was a disruption in the route to market? If at all, any quantification would be helpful. And other than that, is it more of, a demand pickup that you're seeing or specific initiatives you've taken in some brands which has led to this acceleration in the growth?
Yeah, so there could be a small element of restocking. But when I look at the comparator of the previous year, I would say that there is some contribution of this. But I don't think it's hugely material, and what you are seeing is, I think, just improved momentum in a stable regulatory environment and a more probably positive economic environment beginning to show through. I could have explained if it was just 1 month where I saw that happening, but I think we're seeing a consistent momentum through the quarter. It's not as if the numbers have been contributed because of a big bump up in January or anything of that kind, right? It's been consistent through the quarter. So I believe it's more to do with underlying momentum of the business, and just the stable environment has helped more than anything else. I also think that the environment coupled with the investments we've made in our business, and we've stayed true to the course of our strategy, even though there were temptations to cut, right, when the top line was subdued, right? I mean, many people do that when you're managing a P&L. If your top line is not, you just want to cut many other lines to deliver the bottom line. I think we stayed the course on our A&P investment. Yeah, we were ruthless about other costs, but we stayed the course on making sure that we invest on what is strategic for growth. And I believe that helps too. So, our brand is just feeling better in the marketplace. I think demand is coming a bit more easily. And I think all this augurs well, as we look into the future. So, with hindsight, I am glad we did what we did in anticipation of the route to market changes that didn't happen, because we put credit risk ahead of revenue risk, and we just cleaned up the pipeline, right, and reduce the probability of bad debts in a high credit market. We'll continue to invest behind our brand, even though our top line wasn't there. So if you think about it, we took hard calls, come back to that tough quarter with you guys, but just take the course on what we believe in as our management philosophy of what will drive long-term growth and what's the right thing to do in this business.
Right, thanks. That's very helpful. And on the free cash flow generation, this year has been very strong, but partially it is because of the change in the franchising model, and also you had relatively low capex. So as you look into FY19 and going ahead, is there more room to work on the working capital side, and will capex generally be relatively low like it was this year, or do you see an increase in that? That would be my second question.
Thank you. Yeah, I think, we have also said in the past that normally one would expect a capex of about 200 odd crore to be a decent level. Somewhere it will be 50 crore plus, somewhere it will be 50 crore minus. It all depends upon the need for the particular year. Most of the times we are reinvesting back into the capexes, in order to gain productivity. That has been a big agenda for us over the last couple of years, and that's why what you see is our costs almost flattish, because some of the capex that we have invested is about in bottling lines or enhancement in capacities, or looking at various re-engineering to reduce our cost. We would continue to every year do that, and I think the safe assumption would be to assume about 200 odd crore of capex coming in every year. On the second question on the working capital, so absolutely we continue to work on improving the working capital. As you all are aware, this is quite a working capital intensive industry, because you need to really fund a lot of excise and a lot of state taxes ahead of the time. So the capital intensity nature will not come down. But really what we're trying to do is really do a better vendor management, do a good stock management so as to keep our working capital under control. This year has been a phenomenal good year, as you can see from the results. We've been able to cut down working capital almost close to 300 odd crore, which is reflected in the free cash flow. And as such, because of a lower capex spend, we've been able to pay out loan to the extent of almost 800 crores. So yeah, to your point, a good year for free cash flow, a good year in terms of capex management, a good year in terms of working capital management, and finally, in terms of the loan and the debt reduction. And we will just continue to do that every year.
And if I can just add to what Sanjeev said, as part of the management team here, compared to the kind of business we used to run, I think all these things just makes us feel that we are just running a tighter ship here, right? We are just tightening all the things that need to be tightened, investing in the things that need to be invested in. So overall, I just feel that, we are running a business that's in better shape.
Okay, thanks so much and all the best.
Thank you.
Thank you. Next question is from Aditya Soman from Goldman Sachs. Please go ahead.
Yeah, hi. Good afternoon. My first question is on the highway ban. So as we lap it in the coming quarters, do you expect business to be back at full normalcy, or do you still expect that to be there's a large number of stores that are still shut? And just to add to that, even in this quarter, did you benefit from, I believe there was a destocking last year at the same quarter before the highway ban. So was there any benefit just in terms of an easier base?
Yeah. So as far as the highway ban is concerned, I think we definitely have soft comparatives this quarter, which is April to June, quarter one of fiscal 19. And also a somewhat soft quarter in quarter two of fiscal 19, right? So we will have soft comparatives for these 6 months. This is a particularly soft comparative because, first April previous year, the highway ban started and there was so much uncertainty and lack of clarity, which stores will open, which stores will shut. So there was absolute chaos out there in the marketplace. So obviously that hurts business. So therefore, yes, the answer to a simple question is yes, we will be lapping softer comparatives. As far as this particular quarter is concerned, which is our Jan-March quarter, quarter four, yes, there was some softness in the quarter, but not because of the highway ban. See, the highway ban was announced in December of 16 and came into effect from 1st April of 17. So what happened is, in March of 17, we actually pushed in a lot of stock, right? Because in anticipation of the highway ban, right? To whatever extent we could, right? Because we knew that April is going to be very choppy and very tricky because of the uncertainty. So whoever is willing to buy, we try to push in stock in March. So it's not as if we have particularly soft comparatives this quarter due to the highway ban or what happened in anticipation of the highway ban.
I understand. That's very clear. So basically we should be, there wasn't much of an impact this quarter and we should see a significantly softer basis.
Sanjeev, I just wanted to build on what Anand said. I think what has happened is over the last few quarters, whenever we have come back to you, we've been very, very transparent and trying to explain you on the underlying changes and factors that have happened. But the fact is, as Anand said, the last year has been a little choppy year, right? We had demonetization impact, we had highway impact, the expected route to market impact, and kind of overlapping things. For us to really decode each of the elements and really do a pristine breakup of it, it kind of becomes very, very difficult. But yeah, maybe we are lapping up a softer quarter, but the fact is the underlying performance really looks strong. And I think the current quarter, the numbers are really demonstrating that we are coming out of the wood now and is really demonstrating good growth. Yeah.
Oh, fair enough. That's very clear. And just in the second question, in terms of GST, so do you think all the sort of negatives in GST are now behind us? And given that we are seeing premiumization and sort of strong volumes in the premium segment, should we now not expect any further gross margin challenges in GST?
So GST, non-GST related issues are behind us and we have dealt with it. Okay? Now, will this be the end game? Well, I don't know. You'll be there, we'll be there, we'll see, right? Because, what the GST Council is going to decide in the fullness of time, you can never be sure of, right? And I just want to say, I don't see a big risk, right? Because the states also do not want, let's say, the inclusion of ENA under GST, right? But it is something that has come up also twice in the past. And is it completely dead and buried and gone and people are saying it will never come up again? No, we cannot say that. We will do everything in our power and leverage all the states who are like-minded to prevent it from happening. Absolutely, yes. And that's what we did even the last time around. So all I want to say is I cannot guarantee something like that on something as complex a matter as GST where, we don't decide. But certainly all the known things are behind us and under control.
All right. That's very clear. Thank you very much.
Thank you.
Thank you. The next question is from the line of Vivek N. from CLSA. Please go ahead.
Hi, good afternoon. Couple of questions. First, if I reduce standalone pre-tax profits from consol, I get a positive 125 crores which is sitting in subsidiaries as against a slight loss last year. What is driving this such a big swing? Which are the subsidiaries which are contributing to this?
Sanjeev? Yeah, please.
So, Vivek, very happy to answer this question. First of all, it's nice to get this kind of question. Because I think I remember all the questions that were posted to us a few years back. Most of the subsidiaries have been a drag to us in the past. But we are very happy to report that many of the subsidiaries have come back to live business now, and we're really doing well. You already have heard about our IPL franchise business. A lot of things are in the news because of the revised media rights and all. That business is really picking up and doing well. For this particular year, what makes a difference is basically one of our subsidiary listed company, Pioneer Distillery Limited. You've already read that. It's a listed company and hence they had the board meeting very recently. And the numbers were also flashed in the media as well as the stock exchange. We had done some capex investment in that particular plant to revive the business. And that particular plant was getting some incentives from the Maharashtra state government. Luckily, for this current year, about 125 odd crores of incentive has flown in. We still have some capex works ongoing over there, which would mean we would see some incentive coming in the subsequent years. But I would rather not put that as a number that will come to us every year. I would rather say this is a one-off number that is coming to us because we have done some capex investment in the previous years.
Okay, because the gap also is, in terms of profitability, 125 crores. So you are saying take this as basically don't build into numbers as we head into FY19.
Yeah, absolutely. So the number that you're alluding to is the EBIT number on PDF, which is 125 crores.
But Sanjeev, is it possible to, because last year, F17, there was a loss over there. Can we at least assume, standalone console profits now converging, which means that at an overall level, subsidiaries do not remain a drag? Is that a fair assumption?
It's a fair assumption. That's what we're trying to endeavor, all put together. We want to ensure that all subsidiaries put together do not give us a loss.
Yeah.
Okay. Second, on the quarterly, can you just, the three heads, if you can give some views. One is the staff cost. Second is a big jump in other income. And because there are so many exceptions, can you give like-for-like tax rate either for the full year or for the quarter?
Yeah, so I think better to look at from a full year perspective. Let's first start with the staff cost. And I think quarter on quarter will have a lot of funnies, movement and accounting entries. But if you really look at a full year this year and also look at the last year in terms of our staff cost has remained pretty much flattish, about 2 or 3% growth every year. But, that's very good because normally our staff cost is supposed to be having a 10% inflation. But we did take up a lot of restructuring exercise 2 years back, which we had officially announced, and we had also done a lot of severances around that time. That restructuring exercise is really paying off now, given the fact that we see almost a flattish staff cost over the last 2 years.
Okay. Other income, fourth quarter?
Yeah. So other income, the fourth quarter, basically, Yeah, so there are two large components. One is as part of our demonetization program that we have put into place. We have about 65 odd crore of income coming from a property sale, and we also have some interest income reversal in the sense that for some of the loss-making subsidiaries in the past, because of the accounting standard requirements, we were not able to book interest income for the loan given to them because these companies were not performing and were not having the ability to pay back the loan. Luckily, as I explained to you, some of the subsidies are revived back now, which means they will have the capacity to pay back our loan and interest. As such, during the current quarter, we have recognized about 33 crore of interest income from one of the subsidiaries.
And 33 crores will be for full year or for the full year, right?
This is the full year, yeah, because you go up towards the year end and see the capacity of the subsidies to pay back. So this 33 crore is actually for the full year.
Okay. And for FY19, can you give some guidance on the tax rate?
Well, alcohol industry normally, do not have any tax incentives. So by and large, our tax rate remains closer to the statutory tax rate. That's from the book tax ETR perspective. It might fluctuate 1% here and there, but I think broadly it's between about 33% to 34% range.
Okay. And last question, if I may, on the P&A, the revenues are up 14%, but volumes are up 16% like for like. So this negative 2 percentage point delta is because of just market mix?
No, sorry, go ahead. No, please.
Basically, last year, we had some settlement with the customers which we have called out. And as a result, in the last year, there is just an adjustment of 14 odd crore sitting in F17 quarter 4. And that is why this numbers is looking down. So volume is plus 16% and NSV is plus 14%. So there is no adjustment to the volume, but the adjustment is actually happening in the NSV.
Sorry, I just missed you on that. What was the issue in the base?
So there was a customer claim that we had to adjust in the last year base. And if you take out the F17 quarter 4 SEBI results, the full details are there because this was a customer claim settlement that we had to do that for that particular current quarter. We had to take that off from the NSV, but there was no volume impact. As a result, when you compare now, it seems like volume has grown 16%, whereas NSV is growing only 14%. So you have to just do the adjustment for the 14th quarter, and you will get the real numbers.
Yeah. So there is no adverse mix. Just to make it crystal clear, there is no adverse mix. It's because of a one-time adjustment that we needed to do in the base number, right? Because of which the number looks the way it does.
Okay. All right. Thank you and wish you good luck.
Thank you very much.
Thank you. Next question is from Nilay Shah from Morgan Stanley. Please go ahead.
Thank you. So my question is, again, on the staff cost. You highlighted full year numbers are flattish for this year. But given that there's been a change in, the operational model with the franchisees, wouldn't it be fair to say that some of those staff costs have now been transferred to the franchisees? And hence, they should have been lower on a YOY basis. And given that they were indeed lower for the first 9 months, so what explains that?
So, two things. First is if you look at the staff cost for the full year, it's actually come down by about 1%. So the numbers are lower. And I was just saying flattish for the sake of saying it to explain the trend that we want to continue. Most of the franchise work that we've done was associated with third-party manufacturers. So to that extent, whatever staff cost has been eliminated or the overheads have been eliminated is actually sitting in the cost line than the pure staff cost line.
And if I would just add to that, so whatever training we needed to do of our white-collar staff and management staff, that was done over the last year and a half, 2 years as part of the overall organizational restructuring, which we spoke about in the past, where we optimized the organization for a post-franchising scenario model. So we built in whatever trainings we needed in that evolution itself. So part of it is gone because of third-party manufacturers, no impact on our P&L directly, and part of it was done in terms of the overall restructuring. But the way I'd like you to read staff costs is, in a market where salaries go up 6 to 8% a year, we are minus 1%. Okay? And that's how I'd like to read staff cost.
Got it. Second question is, any update on the big asset sales that you're talking about? I know you got a small number this quarter, but any incremental update timeline on the 2,000 crores that you had spoken about?
Yeah, so this year has not been a small number for your information. For the full year, the cash realization is about 137 odd crore, and you know the profit impact is roughly about 105 odd crore. And if you remember last year when we had the same discussions, we said that we have a portfolio of about 2,000 odd crore of non-core assets that we want to dispose of in the next 3 to 4 years. The work has already started in the current year. We would expect in the next 4 years, 3 to 4 years, another 2,000 odd crore roughly should be disposed of, which would largely, you know, if you look at the components, about 1,000 odd crores, we would expect to come from the treasury shares, which is right now litigated, and we have a strong case around that. Roughly about 1,000 odd crores comprises of residential property, commercial properties, industrial properties that we have planned to dispose of in the next 3 to 4 years.
Okay, and just the last question is, any price hikes that you've got in the last 3 to 4 months from any of the states?
So, you know, this has been one of the better years of pricing after having many years of pricing drought. In recent times, we have got Telangana, which was a very different state, by the way. We got a price increase after many, many years in the state of Telangana. And overall this year, we've got, in the previous fiscal, we got price increases in over 15 states, right, in the full year. So it's been both the most widespread price increase year that we've had, but also some stubborn states or difficult states have got unlocked, you know, in terms of pricing in the previous year. So overall, I must say I'm very pleased with the price increase we've got during the course of the year. But, you know, every year is another year, and let's see what happens and whether that trend continues as we look into the future.
Perfect. Thank you very much. All the best.
Thank you.
Thank you. The next question is from Jamshed Dadaboy from Citigroup. Please go ahead.
Yes, sir. Hi, sir.
Hi.
2 questions. This price hikes that you all are referring to, now if I look at your full year sales underlying movement in P&A, there's a 3% volume increase underlying, and the sales increase is only 4%. So is that delta of 1% just price, or has there been negative mix? I'm just trying to understand, after such a good year in terms of price hikes, why is the P&A revenue growth so low compared to the volume growth?
So the price is certainly one component of it. I'll need to go back and look at mix, Jamshed, and we can get back to you on that, because, see, our mix is complicated. One is pricing, of course, helps everybody. There's a brand mix, right? And I need to check whether some of the brands in the middle of Prestige and above grow faster than the top brand, let's say, you know, and see what the weightage is. And also the state mix, you know, in terms of where did the state growth come from. So I think it's a good question, and we'll look at it a bit more, and if you just take that with Nidhi, we'll see if we can put some more light on that.
Yeah, so while we do that, something that I just want to mention to you, when we look at our biggest strategy in terms of how our Prestige and above the premiumization journey looks like, as compared to last year, we were about 58% on Prestige and above. We have now moved to 63%. So which is about a positive 5% improvement coming in. Also from the Prestige and above portfolio point of view, when we look at our NSP growth, and underlying NSP growth, it's about 4% odd, which is definitely higher than the volume growth that we have seen in Prestige. So there is definitely an element of a positive gearing and a positive price mix element coming in. And now beyond that, if you want to really understand the specifics of it, we will definitely get back to you.
We'll try and throw some more light on this. Yeah?
I was just asking that, 15 states have given price hikes, and at the end of the day, if there's only a 1% difference between volume versus value, I was just trying to understand that, how much...
No, I understand. We'll try and get back to you, because there's a brand mix, there's a state mix, and there's a price increase. And where you got the price increase, so price increase would have contributed to 1.5%. right? I need to see the rest of the mix and how it comes. You know, the state-wise NFE is so different in this industry, so we just need to look at that. So, so we will have to come back to you on that.
Second question, you know, when you all think about the future 2-3 years out and you're looking at high teens kind of margin, what sort of steady state inflation are you all looking at or expecting in employee costs and other OPEX, excluding advertising? You know, I mean, advertising, you all have clearly articulated that it's going to be about 9.5-10% of sales. So leaving that aside, what sort of inflation do you expect in other SG&A and employee costs?
So I'll just start and then Sanjeev can add to it. You know, our objective in the near term is to mitigate most of inflation. And I would say in the longer term, to mitigate at least half of inflation every year, right, on a steady state basis. And I believe that's the only way to manage a business in India. You have to, you know, you can pass on a little bit to the market and the consumer, but at least half of it you have to deal with it as management in terms of cost-saving interventions. Our track record on attacking cost, I must tell you, gives us a lot of confidence because for the last 3 to 4 years, we have really trimmed costs, other areas of productivity, but also overhead, staff costs, discretionary overheads, and so on and so forth. And therefore, it gives us the confidence that we have built a bit of a muscle to be able to deal with this on a steady-state basis. So that's what I would say, and that's a general philosophy I'm saying, not specific to a set of numbers. Anyone want to add something?
No, I think that's what it is, you know, and as Anand also said earlier, on the staff costs, you can expect a general 8% inflation, and that's what we see in the industry, from 8 to 10% is the inflation of the staff. Our attempt so far has been to mitigate almost close to 100%. I think going forward is a reasonable assumption to assume that we will still continue work on productivity and at least mitigate 50% of the staff cost. On the cost, you know, while we look at Dina, Mina, packing materials, glasses, everything put together, you know, it's very difficult to put a particular number of inflation, but we think it will be in the range of 2 to 4%. In the last 3-4 years, we have been trying to mitigate almost 100% of it. We would continue to attempt to see that we get closer to that, but I think for the sake of your modeling, it's good to presume that we should be anyway managing about 50 to 75% of inflation mitigation.
Okay, that's very clear. Just a quick follow-up on your working capital. You mentioned, you know, the business released 300 odd crores this year. How do you think about working capital movements going forward? Because as you also said this is a business which generally guzzles working capital.
Yes, I think it's a combination of various things. First, the internal things. What we are really trying to do in the business is to see that we set standards and benchmarks for the kind of various stocks, inventory levels that we want to maintain. I think we have attained a level of efficiency around that. There are certain external factors which is not really dependent upon how we can manage it. It depends upon the state mix. Certain states, for example, Karnataka and various other states where the tax components are really high, if our growth really pushes up there, you will see a component of working capital involving there. But I think what is important internally is we put together a complete rigor around you know, how we're looking at our operating plans and working capital management. So our intention is absolutely to ensure that every year we do not suck any more cash from the free cash flow and, you know, at least ensure the working capital movements are neutral. This year has been a good year for us that we have put together a lot of initiatives. We will ensure to at least make it some positive next year as well, but definitely do not want to intend to put in more working capital as we move forward.
Yeah. And I'd just like to add and say that, you know, working capital is a key management metric for the company and for the management of this company. So you will continue to see focus. Our working capital as a percentage of NSP has come down very significantly this year. And you will continue to see focus in a tough industry which sucks in a lot of cash, all efforts possible to keep minimizing our working capital requirements.
Okay, got it. All right, thank you very much.
Thank you.
Thank you. Next question is from Amit Sinha from Macquarie. Please go ahead.
Yeah, thanks for the opportunity. Actually, just wanted to understand the step-up in the A&P investments which has happened in the last 2 quarters. So is the investment step-up happening on account of higher investment in particular brands? For example, you have mentioned Captain Morgan has a very strong momentum, or you are investing in certain states where you see opportunities of market share gains going forward?
So I think first and foremost, it is choiceful, right? It's not a democratic world out here. So select brands, select states absolutely are what are taking up. So basically a philosophy of distortion of spends is what guides our thinking. Secondly, the deployment, I must say we have very rigorous marketing analytics here. And we have an ROI for above-the-line spend, below-the-line spend, or through-the-line spend. So we have clear metrics of where advertising delivers performance for us and where it does not. So it's not just based on belief. It's based on a philosophy and science kind of merged together, right, to deliver an ambition. So I would say it is done with as much prudence as possible. But the thing with the A&P is you got to first put in the money and then wait for the results thereafter. That will unfortunately always remain the philosophy in this game. But it's done with the belief that it will deliver because it's backed by data and science.
Okay, sir. Sir, I mean, correct me if I'm wrong, but, the way in which I look at in FY17 last financial year, you were gaining market share against the other player, Pernod, and at that point of time, I understand there were other factors also, demon and highway ban, etc. But there was a significant step down on the A&P spend. Now, this year, in the last few quarters, we have seen Pernod performing significantly better. I mean, there might be various reasons, but is the step up in A&P spend also happening on account of catching up on the market share gains?
No, so first of all, I must tell you that, the market share gain is not just a simple trend in one direction. There are gains in one quarter for one player, gains for another quarter for another player, and that's how it's going. All I can tell you is directionally, as I have looked at recent times and at the future, I feel confident about our competitive position in the marketplace. When you look at, NSV numbers reported, some cases they're reported above country, here we report locally, just make sure you're comparing apples with apples, right? And whatever is the comparator, the reporting base of the performance for other people is similar to the reporting base that you're looking at for us. All I can tell you is that I am getting increasingly confident about both category growth reversing in this category and the strength of our brands improving and therefore our competitive position improving. I mean, is it a tough fight out there? Do we have worthy competitors? Absolutely. Okay? But that's what the fun is all about. So I would just say that that's how it's evolving, and I remain confident about the future from a category and a share perspective.
Thanks a lot. So my second question is on your Captain Morgan brand, and the brand has been gaining significant momentum. Just wanted to understand the potential in the next 3 to 5 years, and how has the premiumization drive in the rum market going through, and what is happening to the base brands in the rum market? Yeah.
So I'm delighted with what we've achieved so far on Captain Morgan. Okay. It's really the first full year of the brand, and I don't know if you follow IPL, but this time we had unique cheerleaders this time, right? We had Captain Morgan cheerleaders, because that is about making the brand more salient and riding on a property that has huge eyeballs, right, coming our way. So I feel really good. The potential of Captain Morgan in the future is probably limited by our imagination and our ability to invest. Rum is a 45 million case category in this country. So, anyone can decide what percentage can be upgraded to Captain Morgan, right? I think it's limited by our ambition and our ability to invest, not by the opportunity that exists. Having said that, our McDowell's Celebration rum brand has also been performing well. Particularly in the strong rum markets. McDowell's rum has also been performing well. So overall, I think
participants, please stay connected. We seem to have lost the line for the management. We are reconnecting them. Participants, we have the line for the management reconnected.
Okay. Hi, everyone. Apologies for this. I think we just dropped off somewhere. I'm not sure did I answer the Captain Morgan question fully or did I get cut off?
No, sir. I mean, we missed halfway in that.
You missed halfway. Okay, let me just complete then. Like I said, we are delighted with the performance of Captain Morgan. This is a media dark market. It takes time to build a brand, and I'm quite delighted by how we were able to build Captain Morgan as a brand in its first year. Now, having said that, the size of Captain Morgan in the future, the question you asked, I said that's limited by ambition and ability to invest. We have a 45 million case popular rum category in this country, so anyone can decide how big Captain Morgan can be, given that you have such a large pool to gain from. But, having said all of this, I must tell you, we have a very large rum brand in McDowell's Celebrations Rum. It's the leading rum brand in India in the popular segment, and that's been doing well too. So I think overall, I'm feeling good about rum, and I'm really feeling good at the end of the first year of Captain Morgan, and we're going to continue to invest is all I can tell you. And we will test out how high is high for Captain Morgan.
Okay, thanks a lot, sir, and all the best.
Thank you. Okay, one last question. It's 1.5 minutes to 1, so we'll take one last question, please.
Sure. We'll take the last question from the line of Mehul Desai from IDFC. Please go ahead.
Yeah, hi, so this is Harith from IDFC. Just one question on the margin side. So if you look at the last 2 years, our gross margins have improved over 600 basis points, while the EBITDA margin improvement is about 180 basis points. So about one-third of our gross margin improvement has come in, in terms of EBITDA margin, and most of this has most of the cost medal have gone into, higher advertising and branding spend. Now, if you look at the next, 2-3 years in our ambition to get to this mid to high teen EBITDA margin, would it be fair to assume that most of the, mix/productivity gains that we get on the gross margin side will start to more or less completely flow in, at the EBITDA margin level? Is that the right way to look at it?
Yeah, so let me try and answer this. I think as Anand has said, we are almost like plateaued out on our A&P investments. This year we have 9.6, so 10 is what our ambition is. And absolutely, I think the kind of productivity work that we have done over the last 2-3 years, and which is kind of reflected in the GP margins, which if you see the current year, the GP underlying margin grew by 290 basis. Last year it was about 270 basis. And a large part of that has been in the current year reinvested back into our A&P spends, and that's largely to ensure that we can grow our categories and retain our growth ambitions that we have for the future years. So absolutely, you will see the top line ambition still remaining intact. That we have said that we want to grow our top line by about double digit. And when we say double digit, some of you assume it could be 20%. The fact is double digit is we're talking about, let's say, 10-ish kind of growth every year. And that's kind of reflected in the current quarter without any regulatory hassles. We would definitely want to continue to grow our margins to mid to high teens in the near term. And that's what we have always said that And that's the ambition. We are still continuing to do that, which would mean, yes, you'll see a lot of money flowing back into the margins.
Okay, and the last was on the working capital cycle. So,
sorry to interrupt you, Harit, but we can't hear you. Could you please speak a little louder?
Can you hear me now?
Yes, please go ahead.
Yeah, so and the last thing was on the working capital cycle, so this year has obviously been a function of the, franchisee benefit that we've also got on the working capital days. Are you saying that, internally there is enough that you can do to kind of even improve this, cycle further, X the franchise part, which would now all be in the base as of FY18?
So the benefit of the franchise, most of them is already captured last year. Right, there's not much of a franchise working capital benefit sitting largely in this year. But as we have mentioned, the working capital cycle improvement is a continuous endeavor, and we'll keep on working and improving towards that, right? We have put in together a lot of plans to do that, but can we see the intensity of working capital reducing with this amount every year? The answer could be no, because this is quite a capital-intensive industry. To really grow a double-digit ambition, we need to really pump in also a lot of money into the working capital. But through productive means, what we're trying to ensure that, every year when we land up the next year, we do not really suck a lot of money into the working capital. And of course, we will put together a lot of productivity work that we're doing in terms of managing the working capital very efficiently.
Absolutely. And, this year, just to underscore this, a good part of the cash raised from working capital efficiency is because of efficiencies that have been brought in this year and not because of business model changes. And therefore, I'm just saying it is, like I said earlier, a key metric for this business, and we're going to continue to drive that and make sure we have that kind of tightness on the management of working capital. Okay, so I just want to, with that, conclude this call. Thank you all for taking the time to be with us this afternoon and for your support of our business. Thank you very much.
Thank you.